All right, let's talk a little bit about the history of American banking. This shouldn't take us too long. The idea is that we want to dispel any misconceptions that people have that the banking system we have today is what's always existed, right? It's actually been, really a hard fought battle in terms to get to where it is that we are today. So let's go all the way back, right? If we go back to the first stage of early American banking, this really was centered around Hamilton, who everybody seems to know a lot better now since the musical. If you remember, Hamilton was somebody who was really advocating for some kind of centralized banking system. And for the time being, he won, right? Early on, up until about 1837, there really was a Bank of the United States. The anti-federalists, who were the party of Thomas Jefferson, didn't love the idea of having a bank. They felt that it was the tool of the rich. But ultimately, in the end, it was Hamilton's idea that guided this country through the first several years. And this bank was a bank that American citizens could go into and actually open up accounts, right? This was a bank that was accessible to all people. And really importantly, they issued representative money. And so this kind of provided a stability. What happened essentially in 1837 was that Andrew Jackson was very much against this idea of continuing this bank. And if you remember from American history, he famously vetoed this bank. And so the American banking system went into this stage two, which really was called the free banking era, because at this time, there was only state chartered banks. There was no centralizing mechanism on the part of the federal government to create a common currency or to create a common system. So every state, remember, reserved powers versus delegated powers. So every state was creating their own system of banking. As you would imagine, this led to a lot of fraud. And so if you recall from American history, we talked a lot about panics. These panics were these mini recessions. And these recessions were fueled by fear that there would be bank runs, that people would go to the bank and their money wouldn't be there. There was many different currencies, and so nobody knew whether or not something had real value. It was kind of a mess. That would change in 1863 in the midst of the Civil War. In the midst of the Civil War, of course, the South had separated by this point, and the Lincoln administration needed money to finance the war effort. And so this is when the federal government really first instituted a system that resembled our currency today. This was the first paper currency issued by the US government. As you can see, it looks a lot like our green money, right? It was called greenbacks at the time. You might remember this. And it was really the first time we had what is called fiat money. Fiat money is backed not by gold, right? There's also this misconception that our money is backed by gold. For sure, there are governments who use gold reserves in defense of their currency, right? We've all heard of Fort Knox. But really, money is not equated to gold. You can't turn money in for gold. Money gets its value from the government who issues it, right? That's why we call it fiat money. That's why sometimes if you're traveling you're converting the American dollar to, let's say, the euro, it may exchange at a different rate. Okay, so this floating money, so to speak, can go up and down in value depending on what's happening in a particular country or in a particular economy. Okay, this is very different, of course, than the history of not just the United States, but economic history in general. I'm not going to go, or I'm not going to take you through the long kind of world history approach of money. But keep in mind, if you go back to your 10th grade, back to your ninth grade history classes, when you were looking at historical documents, there was often reference to legal tender or reference to commodities. But this notion of a printed money is really still a very new kind of piece of economics in world history. As a little side note, the Chinese actually did have a paper currency that goes all the way back to the Tang Dynasty. That's really kind of the earliest record we have of that. Okay, but they went through a lot of challenges over the course of their history in terms of how to maintain the value of that money. Okay. By 1863 and then up until 1913, the government increasingly became involved in American banking, right? There was chartered banks issued by the federal government. There was the government demanding that banks hold certain amount of gold and silver. There was this move to issue just this single national currency to kind of alleviate all of the problems of that free banking era. If you remember, this was very much at the center of discussion of politics and the populist movement right in the late 1800s, and this whole notion of farmers wanting to get rid of the gold standard, right? This famously, farmers were being crucified, that's the cartoon here, on this cross of gold, right? The idea was that farmers wanted to introduce silver into currency to try and make money cheaper so farmers could pay back their loans, right? So this has been an ongoing kind of debate since the beginning of the United States, right? About what our money should look like, what kind of value our money should have, how should it be regulated, okay? In 1913, what we do see is the beginning of this stage 3, what I'm going to call our modern banking system. And that was because at this point, the government actually instituted what we call, through the Glass-Owen bill, what we call the Federal Reserve System. This Federal Reserve System sets up a national bank, not like Alexander Hamilton's National Bank, where you and I could go in and open an account, but a system that's really a bank for banks. So the banks that we do business at as American citizens, as Americans living here, are commercial banks, right? So these commercial banks are privately owned, and they're businesses, right? I mean, they're not doing it out of the goodness of their heart. It is a business. But in order to get a Federal Reserve, I guess what you would call acknowledgement, right? That, like, certification, you have to abide by the rules put forward by the Federal Reserve System. So the way this system works is that it's divided into 12 regions. So you can see here, right? The regions where there's more banking tend to be smaller. So you can see how, like, small New York is comparison to, let's say, out in the Midwest, right? Or out in the West. Okay, so these are larger because there's less banking done here. But there's 12 different regional banks. And there's also a Federal Reserve Board in Washington that has 7 members. The Federal Reserve Board chairperson, who right now is Jerome Powell, tends to be and has always been really apolitical. This is such an important position that people don't want to politicize this role. In fact, there's a lot of presidents of different parties who maintain the same chairperson throughout multiple administrations because they want to provide stability and they don't want to undercut the power of the Fed. What this Fed does is it's responsible for our national currency, for dollars, right? What we call Federal Reserve notes. And they really do, as I mentioned, provide services to those member banks. Now, those services, right, can vary greatly, and we're going to get more into that. And if you haven't yet explored monetary policy, you will soon. And monetary policy is the major tool of the Federal Reserve System. And it really is the way in which our US banking system has operated over the last century, right? Now, keep in mind, right, it hasn't always been a smooth ride, okay? The Federal Reserve was already in operation when the Great Depression hit, as an example, right? We know that there were bank runs and there was all kinds of defaulting on loans. And of course, the economy plunged into a prolonged recession. It was after this Great Depression that the FDR's administration strengthened banking above and beyond the Federal Reserve to include the FDIC, which ensures the deposits that we have in our accounts in these commercial banks. And essentially, there was this push to regulate banks more closely. Okay? By the 1970s and 80s, there was a push to deregulate banks, right? This idea was that there should be more freedom. Think about those economic values, right? There should be more freedom, maybe less security, right? Not saying no security, just maybe that more freedom will help grow the economy. And so in a series of different acts, there was a move to deregulate banks, and mergers happened, and banks started to get involved in the sale of stocks and bonds. And this really did grow the economy. The really interesting thing about this is that by the time you get to the beginning of the new millennium, we do start to see kind of cracks in this system. I like to point out to people that in the textbook that we have in the classroom, the green book that I know I've shown you, That was copyrighted in 2005. And one day when I was kind of leafing through that book, I came across this section that talks about the evolution of American banking, like we're talking about here. And it actually says, has shifted between centralized and decentralized, leading to the stable banking system of today. What the editors of that book didn't realize is that within the space of 2 years, 2 years after that book was copyrighted, we would experience the Great Recession, right? The near collapse of our entire banking system that nearly brought down, the economy worldwide, and did in some cases really destroy the economies of some countries. There was multiple bank failures, and there was an overextension of credit, and there was a default on mortgages, and it really was a time of high unemployment. It really was a time where the GDP really, for an extended, more than just a 2 quarters, but for an extended period of time, declined. And it really took a good 10 years to actually come back from the Great Recession. And so that leaves us here, right? Kind of the focus of this entire unit. To what extent should the government be involved in our economy, and specifically in this case, in our banking system? Are we better off with a banking system that is let to grow, and encourage investment and provide opportunity? Or are we better off having more oversight over banks and more regulation? And that might slow growth, but it will provide security. There is, of course, no right or wrong answer to this question. And that's why it's controversial. And that's why economics is a social science, not a science. Okay. In the end, whatever your opinion is on this particular question, all parties want a healthy economy. It's just, how do we get there? Okay, so I'll stop here, and you can move on to your next activity.